Hello and welcome back, options traders. So what is the volatility crush? Well, if it's a term you're not familiar with, you'll want to be sure to watch this video because it is a risk that catches every single options trader off guard at some time or another, and especially all of the new traders. So it's a risk that occurs when traders make a play on an upcoming earnings or maybe an FDA announcement, something that's quite common during the coronavirus pandemic. A lot of traders trying to play the news. And that's okay, they're highly speculative, but if you don't understand the volatility crush, you're going to find out there's a lot of times, almost 100% certainty, that that stock might actually move in the direction you thought, but you could still lose on the option. And it's all because of the volatility crush. So what is the volatility crush and why does it occur? Well, the volatility crush is the idea that the implied volatility gets sharply reduced when impending news is finally released to the market. So again, it's usually things like earnings, FDA announcements, Federal Reserve coming out with some type of a speech, or somebody's going to make an announcement about something. And this news is circulating in the market, and the option prices start getting bid up higher and higher, and so traders try to make a play on these announcements. But what happens is that if the implied volatility gets sharply reduced after that news is announced, well, that's a risk that catches new traders off guard. And one of the traps that traders step into is they might look at their broker's platform and say, oh, my option's got a theta of 10 cents. So it's only going to lose 10 cents between today and tomorrow. But what they don't realize is that the numbers that you're looking at on your broker's platform, those option prices assume that volatility remains the same during the option's life. That's one of the main assumptions of the Black-Scholes model. And so if you are looking at your broker's platform and saying, I'm only going to lose 10 cents between today and tomorrow from time decay, but there's a volatility crush coming, those theta values won't reflect the true decay. Why? Because the volatility changed. And you're making this assumption that volatility is going to stay the same. So let's take a look at an example of how this happens. So let's look at a hypothetical option. Let's say we've got an at-the-money option, stocks at 100 strike, 30 days to expiration, 1% interest. And I chose this 17.2% volatility because that just happens to give us a nice round $2 call option figure. So let's just say this is what we might call normal circumstances for this stock, that it normally trades around about 17% volatility. And so we would normally see this call trading for about $2. So here are potential stock prices. As I've talked about in other videos, remember that the current stock price of 100, we can think of it there is an implied bell curve sitting directly over the current stock price. And the width of this bell curve, or the volatility, is what dictates how much that option could be worth. Could it only go up to 105 and down to 95 maximum? Well, don't expect the option to be worth that much. So under these conditions, under this volatility, yeah, we might see that $100 call trading for 2. But now some news starts circulating in the markets, and people are saying, you know what, this upcoming earnings, they're thinking it could be a really blowout earnings, and that stock might be up a whole bunch. And traders start talking about this, or reading the message boards, listening to analysts, and they're all saying, yep, that's the news. And so what they're really saying is that there is now a wider potential. Yes, it could be up higher if the news is good, but maybe it could also be down more if it's bad. So we just have a wider potential range for stock prices, and that's the definition of higher volatility. And so what that's going to do is that traders will say, well, you know what? Because my call option might be worth more if the stock goes up, but I'm not going to be harmed if it goes down. Remember, call options have an asymmetrical payoff. They help us on the way up, but they don't harm us on the way down. So traders start competing for this, and they'll say, well, yeah, it was worth 2, but I'll give you 210, 220, 230. They start bidding it up, and then suddenly it's trading for, let's say, $3. And then what happens? More news hits the market, and we start seeing that other analysts are jumping in saying, you know what, it's going to be even bigger than expected. This stock price could be way up here at 115. But if they miss, yeah, it might be way down here. There's just a wider range of potential prices, i.e., there's more volatility. So traders say, you know what? I'm willing to easily pay 3, but others say, well, I'm willing to go 310, 320, 330. Pretty soon it's up to $4. And then more news circulates. What happens? We end up with more guesstimates that the stock price might be way up here and it might be way down here. Just a wider range of potential prices. And so traders start getting into bidding wars, and we find this option is no longer trading for 4, now it's up to 5. And then what happens? We get more news that hits the market. Much wider range of potential prices. People are thinking it could be anywhere. Well, that's great for a call option. And so the price starts getting bid up even higher. Now it's trading for 6. And this just goes on and on and on. And maybe let's say our option is eventually bid up to $8. Now keep in mind, under normal circumstances, it was trading for 2. So what happened? Why is this now trading for 8? Well, if we go back to our pricing model, we see that we keep all of the factors the same, but the current market price is 8. How can I get this $8 price to balance over here? Well, the only thing that I can change is volatility, right? The stock is still at 100. We still have the 100 strike. Time to expiration is the same. Interest rates are the same. The only thing that traders could be changing is their assessment of volatility. So we're just working this backwards. This is what's called the implied volatility. It's the number that we need to put in here so that it equals the current market price. All right, yeah, it's actually technically 803, but I just wanted to use a nice round number of 70. So you might be looking at this saying, okay, if I pay this roughly $8, but look at my theta, 13 cents. So if I pay this 803 and I subtract off the 13 cents of theta, which is what it's expected to lose between today and tomorrow, yeah, my option should be trading for about $7.90 tomorrow. And if the stock goes up like I think it will, it could only get better from here. Well, once again, that is assuming that this 70% volatility figure right here stays the same. And if that's true, yes, this 13 cent theta will be absolutely true. But remember, in the real markets, this is often changing. So let's say that the news is announced and the stock opens up for trading at 103. So now you're thinking, well, my $100 call, I paid 8. It's now got $3 of intrinsic value, should be trading for 11. Yeah, okay, we got to subtract off the 13 cents of theta, but it should be trading for somewhere around $11. So you can't wait to sell for this big profit. You log onto your platform and you see that the $100 call is trading for $3.87. And you're saying, what in the world happened? I paid 8 for it yesterday. I'm only losing 13 cents of theta, and I've also got another $3 of intrinsic value. What is going on here? It's the volatility crush. Here's what happened. Let's put the stock at 103. 1 day later, we've got 29 days till expiration, but notice I didn't keep the volatility at 70%. It now dropped back to its normal levels. Why? Because the news is out. People aren't willing to pay those excessive premiums for the right to walk away, because now we know the answer. Yes, yesterday we thought the stock might be up to 115, maybe 120, maybe 130. We had all of these wild estimates. But now we know the answer. The stock is trading for 103. So why should we pay 70% volatility now that we know the answer? So once the traders go, well, yeah, that was yesterday, I was willing to pay at the rate of 70% volatility, but today I'm only willing to pay 17%. So did you capture the intrinsic value? Yeah, there's $3 of intrinsic value and the option's trading for at least 3. But look at your extrinsic value. It went from about $8 to 87 cents. Why? That's your volatility crush. So the thing to remember is that the implied volatility, that number that we saw, that 70% figure, is a forward-looking volatility. People are willing to pay that rate only because they don't know the future. They're paying this excess premium for the right to walk away. Remember that an option is also an insurance policy. So yes, we're going to be better off maybe losing 8 instead of losing far more if we buy the stock. And because of all of this uncertainty, we're saying, you know what? Yeah, I used to be willing to pay 2, but today I'm willing to pay 8. So we're willing to pay the high premiums because of the future uncertainty. That's what implied volatility is. But once that news is released, that volatility no longer applies. It's gone. It's old news. And so unless something else comes up, you're going to find that that volatility for that stock is probably going to fall back to its normal levels. So therefore, if you think that the time decay that you're seeing on your broker's platform applies, and that in this example you could subtract off 13 cents and that would be a good estimate, that's a very big assumption. The time decay that you see on your platform assumes that the volatility stays the same. And this is one of the main reasons I'm not a big fan of playing the earnings. It's not just about guessing whether the earnings will be better than expected. It's about understanding how the crowd is going to react. And it's also about understanding and trying to estimate the volatility crush. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course. You can find it all at optionsatoz.com. You can also instant message me right here in Facebook.